Welcome to Talk Tickers. Today, we're breaking down the Q3 earnings for Boston Beer. That's ticker SAM. Now, this was a really interesting one. The stock popped over 5% after the report, but when you look under the hood, there are some serious complexities. So let's get right into it. Okay, here's what we're going to cover. First, we'll hit those headline numbers that got everyone talking. Then, we're going to dig into the real story this quarter, which is all about the margins. From there, we'll look at management's playbook, talk about the headwinds they're facing, and then wrap it all up with our take, the next call. All right, let's kick things off. Boston Beer's third quarter, well, it was a bit of a head-scratcher, honestly. You've got the top line and the bottom line telling two totally different stories. It really sets up this puzzle for investors. So, on the one hand, they absolutely crushed their earnings estimates, and the market loved to see that. But on the other hand, they actually missed on revenue. And that right there is the big question for the quarter. How in the world do you boost profits when you're selling less stuff? Okay, let's put some numbers on this. The GAAP earnings per share came in at $4.25. Now that's a huge beat. We're talking 47 cents better than consensus. That's more than 12% higher than what Wall Street was looking for. Just a really, really solid performance on that bottom line. But then you look at the top line, and it's a completely different story. Net revenue came in at $537.5 million. That's a miss of about $4 to $5 million. But honestly, the bigger deal here is that it's an 11.2% drop from this time last year. That's not the direction you want to see sales going. So that brings us back to the puzzle, right? How do you pull off a big earnings beat when revenue is falling off? The answer, and really the entire story of this quarter, is all about margins. This wasn't a growth story at all. It was a story about pure, disciplined execution. So yeah, revenue is down. Sales volumes are down. Where did this profit surprise come from? It boils down to one thing, really: incredible operational discipline. And here it is, the key number for the whole quarter. Gross margin expanded by a massive 450 basis points. That's 4.5 percentage points. It hit 50.8%. And you better believe management was excited to point this out. It's the highest margin they've had since 2018. This right here is what drove that earnings beat. Now, a jump like that doesn't just happen by accident. This is the payoff from a multi-year slog to get their supply chain in order. We're talking about getting better prices on things like packaging and ingredients, making their breweries run way more efficiently, and, this is a big one, shifting a ton of production in-house. They're now making 90% of their domestic volume themselves, up from just 66% last year. That gives them way, way tighter control over their costs. Okay, so they've got these incredible margin gains. The really interesting part is what they're doing with all that extra cash. They're not just banking it and calling it a day. Nope, CEO Jim Koch was super clear about this on the call. He said, and I'm quoting here, "We are reinvesting some of our gross margin over delivery into additional advertising spend." Basically, they're taking the money they saved from being efficient and plowing it right back into marketing to fuel future growth. So the playbook moving forward is pretty simple, really. Step 1, push hard on their new innovation, Sun Cruiser, which is doing really well. Step 2, follow through on that promise to reinvest, ramping up ad spend by an extra $50 to $60 million. And step 3, keep doing what's working. Continue to improve those margins and control costs. And when you look at their brand portfolio, it's kind of like a tale of two cities right now. You've got some real bright spots. Sun Cruiser's taking off, and it's great to see Angry Orchard back in growth mode. But then you've got the headwinds. Their biggest brands, Twisted Tea and Truly Hard Seltzer, are both facing some serious pressure. So let's talk about those headwinds, because while that margin story is fantastic, it's all happening against a pretty tough backdrop when it comes to volume. To their credit, management was very open about the challenges they're seeing out there. We're talking about consumers pulling back on spending, a broader trend of people just drinking less, and even new competition from hemp-derived drinks popping up. They also called out specific pressure on buying rates from Hispanic consumers. And you can see this weakness in a key metric called depletions. That's basically a measure of how much product is getting pulled off the shelves by consumers. And those were down 3%. It just goes to show that even with powerhouse brands, they're not immune to what's happening in the broader market. Now, shipments, that's what Boston Beer sends to their distributors, that number was down a much steeper 13.7%. But you got to put this in context. This was pretty much expected. They had to stuff the channel with inventory earlier in the year to get that big Sun Cruiser launch off the ground, so now they're just rebalancing things. All right, so let's put all the pieces together. You've got this amazing margin story on one side, but this persistent volume problem on the other. Here's our take on SAM. This is the next call. First off, because of that incredible margin performance, management felt confident enough to raise their full-year EPS guidance. That's a huge signal of confidence, and it's exactly what the market wanted to see. The stock got rewarded for that execution. So for our rating, we're calling this a market perform. Look, the operational excellence is truly impressive, and it puts a solid floor under the stock, in our view. But you just can't ignore the volume headwinds hitting their biggest brands. It's a classic balancing act. Looking ahead, we really see this stock caught in a tug of war. The margin discipline should keep the stock from falling apart. But if you're looking for a real upside, you need a growth story. And right now, that story pretty much boils down to two things: how well Sun Cruiser does next year, and whether they can stop the bleeding in Twisted Tea. In the meantime, expect the stock to stay volatile. Now, for those of you looking for a more actionable idea on how to play this, we think there's a really interesting setup in the options market that captures this tension perfectly. We're calling it the margin versus volume collar. Here's how it works. You buy a put option for, say, early 2026 to protect yourself if the volume situation gets even worse. Then, to pay for that protection, you sell a call option at a higher price. What this does is it basically bets on the stock staying in a certain range. The idea is that strong margins prevent a total collapse, but the weak volumes are going to cap any huge move to the upside. And of course, we always have to say it, this is for informational purposes only. This is not financial advice.